Preparing for a revenue recognition interview? You've reached CandiMentor, and this video is for you. We'll walk through 10 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is the 5-step revenue recognition model under ASC 606 and International Financial Reporting Standards 15? Revenue recognition is the process of recording revenue when a company satisfies its performance obligation, not simply when it invoices or collects cash. Under ASC 606 and International Financial Reporting Standards 15, I identify the contract, obligations, transaction price, allocation, and timing of transfer. For example, a 1-year subscription paid upfront creates deferred revenue, recognized as service is provided. That distinction prevents premature earnings and improves comparability across companies and periods. While answering, focus on identifying the contract, determining performance obligations, calculating transaction price, allocating consideration, and recognizing revenue when control transfers. Question 2. What conditions must be met before a contract with a customer exists for revenue recognition purposes? Before recognizing revenue, I confirm that both parties have approved the arrangement and are committed to performing. Each party's rights are identifiable. Payment terms are clear. The contract has commercial substance, and collection is probable. If collectibility is not probable, I generally cannot apply the normal revenue model yet. I would also reassess the contract if circumstances change, because a previously valid arrangement may require different accounting later. Make sure to cover approval, identifiable rights and payment terms, commercial substance, collectibility, enforceability, and reassessment when facts change. Question 3. How do you determine whether promised goods or services are separate performance obligations? I treat a promised good or service as a separate performance obligation when the customer can benefit from it on its own or with available resources, and when it is separately identifiable from other promises. A software license and implementation service may be distinct if implementation does not significantly modify the software. Conversely, highly integrated engineering and construction activities may form one combined obligation. The conclusion drives both allocation and revenue timing. In your answer, talk about whether the customer can benefit independently and whether the promise is separately identifiable within the contract, including integration and modification considerations. Question 4. How should a company account for variable considerations such as rebates, refunds, bonuses, or penalties? The business context matters because variable consideration can materially overstate revenue if estimated too aggressively. I estimate the amount using either expected value or the most likely amount, depending on which better predicts the outcome, then apply the constraint. Include only consideration unlikely to reverse significantly. For example, anticipated customer rebates reduce transaction price. I update the estimate each reporting period and record changes prospectively or cumulatively as appropriate. Be sure to mention estimating expected value or most likely amount, applying the constraint, using historical experience, and updating estimates each reporting period. Question 5. How do you allocate transaction price among multiple performance obligations? I allocate the transaction price based on each obligation's relative standalone selling price at contract inception. If a bundled contract totals $900 and standalone prices are $800 and $400, I allocate $600 and $300 respectively. I use observable prices when available. Otherwise, I estimate using market assessment, expected cost plus margin, or residual methods when permitted. A discount may be allocated entirely to one obligation if evidence supports that conclusion. Focus on relative standalone selling prices, observable prices, adjusted market assessment, expected cost plus margin, residual approaches, and allocation changes when discounts relate specifically to one obligation. Question 6. How do you decide whether revenue should be recognized over time or at a point in time? I recognize revenue over time when the customer simultaneously receives benefits, controls an asset as it is created, or the asset has no alternative use, and the company has an enforceable right to payment for work completed. Otherwise, I recognize revenue at the point control transfers. For overtime arrangements, I use output measures such as milestones or input measures such as costs incurred, provided the measure faithfully depicts performance. Discuss transfer of control, customer simultaneously receiving benefits, customer-controlled assets, no alternative use, enforceable right to payment, and suitable progress measures. Question 7. How should a company account for a contract modification? I first determine whether the modification adds distinct goods or services at their standalone selling prices. If so, I account for it as a separate contract. If not, I assess whether remaining goods are distinct. The modification may be treated prospectively as a termination and new contract, or through a cumulative catch-up adjustment when obligations are not distinct. The accounting depends on the revised rights, obligations, pricing, and transfer pattern. In your answer, distinguish separate contracts from prospective terminations, cumulative catch-up adjustments, and modifications treated as part of the original contract. Question 8. How do you determine whether a company is acting as principal or agent? The key question is whether the company controls the specified good or service before transferring it to the customer. If it controls that item, it is the principal and records gross revenue. If it merely arranges for another party to provide it, it is an agent and records only its net commission. Indicators include primary fulfillment responsibility, inventory risk, and pricing discretion, but no single indicator is determinative. Make sure to cover control before transfer, primary responsibility, inventory or fulfillment risk, pricing discretion, and whether revenue is presented gross or net. Question 9. How are warranties, returns, and customer options treated under revenue recognition rules? An assurance warranty generally creates a separate warranty provision under relevant liability guidance, while a service warranty is a separate performance obligation with allocated revenue. For returns, I recognize expected revenue net of a refund liability and record an asset for the right to recover products, adjusted for recovery costs. A customer option is a separate obligation when it provides a material right, such as a meaningful future discount. Discuss assurance versus service warranties, refund liabilities, right of return assets, material rights, expected value estimates, and reassessment of these balances. Question 10. What journal entries and disclosures would you expect for a company with upfront billing and ongoing service delivery? Suppose a customer pays $120,000 upfront for 12 months of service. Initially, I debit cash and credit a contract liability for $120,000, assuming payment is received immediately. Each month, I debit the liability and credit revenue for $10,000 as service is delivered. I would also assess receivables, contract assets, and fulfillment costs. Disclosures should explain disaggregated revenue, opening and closing contract balances, remaining obligations, and significant judgments. Cover contract assets, contract liabilities, receivables, revenue release, fulfillment costs, significant judgments, disaggregation, remaining obligations, and useful control checks. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.